Okay, Rob, the last time you and I got together, we thought things might get a little bit exciting.
Yes.
I didn't exactly expect what we have in the markets now.
Yes.
But let's just cut through it a bit because obviously emotions are high. Sentiment, is driving a lot of what's happening. I think there's a huge amount of attention on the Fed. Whether that's appropriate or not, we can we can discuss. But when the spirits in the markets are alive like this, it's often helpful to have a little perspective, and hopefully we don't add to the noise out there.
Yes, trying to cut through the noise, I think, is the important thing. So one thing I've found interesting is looking back at charts just over the past few months, it becomes readily apparent that equities, which obviously have been down a lot the past few days, are really just back to levels where they were in May. And one of the things that was very interesting about that move from May through now has been the expectation that we would get a lot of Fed rate cuts and at the same time maintain the sort of higher than average growth backdrop that we had been in post-pandemic. Of course, our view had been that the economy was slowing but not entering recession. So the market seemed to be a little bit surprised, I think, by the reality that the economy is in fact slowing. But there's maybe a little bit of overreaction here as well, as the market isn't entering recession. So just to recap a little bit in the near term, the data points from the past week had been that the ISM manufacturing number was a little weaker than expected. The job growth number was a little weaker than expected. But everything else was sort of pointing to an okay economy. All the real-time readings on economic activity and payrolls were, in fact, expanding, not contracting. And just today, we got the ISM services number, which came in a little better than expected, especially on the employment and new orders front. So we take this all together and cut through the noise and say, perhaps things had gotten a little too optimistic, sentiment had gotten a little too positive over the past few weeks, and now we're having a very rapid reversal of that. But the underlying message doesn't change. We're in an economy that's growing, albeit at a slow rate, and in a backdrop where rates are likely to trend lower over the next few quarters rather than higher. So the underlying picture hasn't changed, but a lot moved in the last few weeks. First up, then down.
Yeah. So, okay, a lot hasn't changed, but fundamentally it has to be about the economy and therefore earnings.
Yes.
We're investing in companies because they're in business and they are producing a profit, right, that accrues to the benefit of shareholders. It feels like the market, that is those in the market, are still stuck in whether they're just as a casino and a gambling mentality with high growth, as you said, post-COVID, driven by the interest rate regime and liquidity from the Fed, or are we going to get back to looking at a real economy that's growing, albeit slowly, and examining the fundamentals of companies?
Yes, and I think we will get back there. We just have to cut through a little of this noise of the change in backdrop. I think a key element of that will be some clarity from the Fed. We've been telegraphing for a while that we're hopeful that in August at the Fed Jackson Hole Symposium, they provide some clarity on what will the path be towards normalizing interest rates. We think it will be a reasonable one and consistent with, as you say, economy still expanding and earnings still growing. So we've done a lot of research that shows that GDP growth around 2%, which seems to be where we're tracking presently, is a healthy backdrop for earnings. Past earnings season was okay, some signs of slowing, but it was a decent earnings season. So the fundamentals, as you've said, remain fine, albeit at a slowing rate.
But again, that's about the path.
Yes.
Therefore, we can focus on real company earnings and the fundamentals, as opposed to hanging every month or the next 3 months on what the Fed may or may not do. One reason I want to hopefully avoid adding to noise out there is inevitably investors listen to commentary, including ones like this, and think, well, what should I do now?
Yes.
What does this mean? When in reality, if you've done a good job with your money, or more to the point, we've done a good job. Right. We've allocated resources, our clients' portfolios, in such a way that they are meant to ride through periods like this.
Yes.
They are allocated in order to take a much longer view and not get caught up in what's happening this week or, frankly, the next 6 months.
Yes.
And that often gets gets lost.
It gets very lost at times like this when you have extreme movements. And in fact, I was talking about that exact topic on a call today and said, I'm sorry to disappoint you, but the boring answer is, if things were done properly to this point, you shouldn't need to make any changes. We've been encouraging rebalancing as markets have gone up quite a bit this year. Stay within your risk tolerance ranges. But the moves of the past few days don't change anything about the underlying fundamental picture and the need for people to remain invested consistent with their risk tolerance.
Assuming it was allocated in the first place.
Assuming
now, the question mark about maybe when you do something really applies to folks who haven't dealt with that.
Yes.
Who got caught up in a very momentum, sentiment-driven market the past couple of years, and basically, whether they know they're exposed or not, are exposed to 7 stocks or like assets.
Right. Yeah, there had certainly been a lot of, let's call it excess optimism in the past few months, and I think some of that's being corrected very quickly in the market here. But for folks who've had a more diversified portfolio consistent with their risk preferences, as the types of portfolios we construct here are, then things are quite fine. These types of moves happen all the time. As I mentioned, we're only back to where markets were in May. We're still up on the year.
And
this
even
is
if
not
it's
a disaster scenario.
And even if the market were to drop, I don't know, something like 20%, we'd be back to where the market was in 2023.
Yes.
So, we definitely have to have a perspective. Another place to have perspective, emotionally, when we think about it, is to realize the kind of environment we're in. In our last discussion, I mentioned the silly season, meaning politics. And so we've got this outsized influence on the political environment. We have all sorts of international tensions. It's very easy to get caught up in that noise as well, instead of thinking about the fact that we've always had this.
Yes.
And we've always had these kinds of situations. There's always news to grab your attention and sell you advertisements.
Indeed. Always noise, always a lot of things to overreact to. And that's one of the reasons why we set our official forecast period at a 3-year time horizon. 1 year is enough that the sentiment can rule everything. You could have an okay year in the last month of the year. You get something like we've seen the past few weeks, and things change pretty significantly. But our work shows that over a 3-year time horizon, fundamentals really are what drive outcomes. And so while we are not sitting back and being complacent over the course of 3 years, 3 years is consistent with when fundamentals work. They certainly don't work over a 3-hour period.
So very briefly, let's end on fundamentals and 3 years. Where do we see things right now with regards to allocation and in the environment in general for how you think about the world?
So the very short and simple answer is that our view on the economy is that we're returning to the pre-pandemic economy, which is slow growth, around 2%, which is long-term trend growth in the U.S. That translates to mid to high single-digit earnings gains, which is what we expect for appreciation in stock prices over the next 3 years, driven by the earnings side. No change in valuation. Regardless of how quickly or when the Fed moves, we expect valuations to remain stable over that 3-year period and grow on the basis of underlying fundamentals. So for that reason, we've been slightly overweight equities, and we've maintained a posture of balance across the portfolio's diversification. We do think gains will start broadening out in markets once this Fed cycle gets underway and some of the noise dissipates and we get back to a more normal and fundamentally focused environment.
Great. Thanks so much, Rob.
Thank you. Always fun, Rick.
Yep.